Welcome back to the Financial Shepherd Podcast. My name is Joshua Casey Garland, certified financial planning professional, founder and CEO of Shepherd Wealth Management. Glad to be back in studio here today for episode 15 of season 3 podcast. Can't believe it's been 3 seasons already, Ez, but
I can't either.
Here we are, man.
I can't either. We made it through some times, didn't we?
We're still going through some stuff.
Still going through some stuff.
Yeah, I got to get this off my chest today. So all kinds of stuff to talk about. We just got CPI data, PPI data today, this morning, and all kinds of other things that we're going to talk about as it relates to the market, both in the short term and as we get into next week, kind of my thoughts on what next week might bring to us. But before we get into that, man, I got to hear a little bit about this trip you took over to Hawaii.
Oh, yeah. It was exactly how you think when someone's like, hey, I got to go back to Hawaii for the second time this year.
And you missed out on all the devastation that's actually happened over there.
Yeah. I mean, thankfully, it's kind of hard to be thankful for dodging a bullet like that when so much hellish imagery and ruining of lives is on TV. But all the people that I know and love and that live in Hawaii are on a different island.
Yeah.
And I've actually never visited Maui.
Gotcha.
I've been to several other islands though. So I missed all of that. Although we did catch the hurricane, the winds were blowing on the western part of Kauai when I was there the last couple of days. And we did notice it was substantially windy, but at that time the fires hadn't popped off on Maui for it to be a state emergency. So we didn't really even know they were an issue.
Yeah. I know FEMA's going out there and they can't even really get a real decent estimate on damages, but we're talking like at least $3+ billion. And I know that like State Farm's a huge insurer for property out that way. Geico, which is Berkshire Hathaway, they are pretty big in autos out that way too. So there'll be more details to come as relates to all of that. But definitely hope FEMA can get out there real quick and get these people some shelter, water. I know for sure, like on the island, there's like no room in hotels and all that other stuff. So
yeah, I can only imagine. And that's the thing is it's so remote. It's not like you hear about it and you can just hop in your car and drive overnight and be there in the morning to help out. It's not easy to get to.
No doubt. Certainly hope thoughts and prayers out to all those folks affected by it, and certainly hope they're okay and get some solid footing going forward here. I know that's not fun because we dealt with some of this stuff. Not to the same magnitude probably, but Hazard, Kentucky, right here in our own backyard. I kind of spent a day out there. I could hop in the car and drive the 3.5 hours to help out with that cleanup. And that was the wildest thing I've ever seen. FEMA was out there for that as well with a bunch of others. So best of luck for everybody that's out there dealing with that, and certainly hope everything gets better sooner.
Yeah. And, I can attest from my time with Hurricane Katrina. If anyone has any ability to help in any way, it all matters. $5, $10, $500, just do what you can to help out. I mean, those are not only are they people, there are other Americans that are in trouble.
Yeah, no doubt about it. And I know that I want to go see that place one day. I haven't got out there. So
yeah,
looking forward to that. Hopefully in the future, no timetable set for that. Definitely on the bucket list, if you will. But I got a lot of things on the bucket list. So
yeah, me too. Go to space. Number one.
Well, I actually on my number one maybe to go see all the Major League Baseball stadiums because I'm just a huge baseball fan.
Yeah.
But that's up there too.
That's a great bucket list.
I digress. It is a good bucket list, but I don't think the people are here to listen to me talk about all the fun things I want to do one day. So we'll get to the meat and potatoes of today's podcast, which I'm excited to talk about. So we got some cool data, mainly July CPI. We got that, and that came in below consensus expectations. I was kind of calling for that. I believe that this is sustainable. I think this is really the crux of the market right now here today that's happening as I'm talking Friday, August 11th. It's been going on all week. I think the market's really trying to figure out, is this sustainable? It's been 2 CPI prints in a row that came in below consensus expectations. And that's really what the Fed themselves have been talking about, is we were data dependent and we want to see a sustainable path towards our core target of inflation of 2%. And this has been 2 prints in a row. I think if we get one more next month in September, that's below consensus expectations. Now we've gotten 3 straight months in a row of inflation falling faster than what consensus believes. And to me, that is the green flag that the market's looking for as an all clear signal that, we might be higher for longer on the Fed funds rate, meaning that they're not going to cut rates for the rest of the year. I don't think anybody should expect that at this point, unless something terrible happened. That would actually be really bad for the stock market. But If that actually is the case, we are at peak rates and there are no more rate increases for the remainder of this year. Markets look forward 6-9 months. And then they can start to look at, okay, if the economy is still growing and jobs are still plentiful and unemployment is still low and inflation continues to fall for the remainder of 23, the market's going to say, hey, that is, quote, that's the soft landing narrative. Now you almost have to cut rates sometime in the beginning of 24 because why keep Fed funds rates so high when everything else is so stable?
Right.
So that's what I want to get into today. CPI again came in lighter than expected. It came in at 0.16% month over month. Consensus was looking for 0.22%. One thing that ticked me off initially here is when that news came out a couple of days ago, they rounded that 0.16 up to 0.2, and it said it matched, consensus expectations. To me, that was, it just like bothered me. Right. Because I know that number, if it was shown as
what it was,
as what it really was, not the 0.2, that consensus. Yeah. So they're showing I'm watching CNBC in the morning at 8:30, the CPI is rolling out and it says, it came in line with consensus at 0.2. Well, the reality is it wasn't.
No, it beat it by 20%, which is a huge margin of victory.
It bothered me. And no doubt. So I'm watching this and I'm like, this is my Super Bowl. I'm going nuts, having a cup of coffee, haven't got changed, ready to go to work just yet. My family's like, well, what's going on? I'm like, hey, CPI came in below consensus expectations. And they're like, oh yeah, I get it. So they're going on about their morning. The market popped immediately. Pre-market popped. Stock market opens up 9:30. By 10 o'clock, we're sitting almost at 1.7, 1.8% on the NASDAQ positive. Dow was up more than 1%. S&P was up about 1.5%. And then something happened between 10 a.m. and 2 p.m. where the market just sold off, all 1.5%. Market actually went negative 4 point there before finally finishing, between 2 and 4, slightly positive.
Wow.
So this is, to me, what the market's trying to figure out is this sustainable? This inflation number that we've been getting last month and now this month being below consensus, is that sustainable? Yeah. I believe it is. And I'm going to give some reasons why as we get into this podcast here today. But what was interesting was that sell-off between 10 and 2. So I want to touch on that a little bit because you got the number that I was looking for and expecting. But when the market does that kind of movement in that short of a span of a time after good news, it makes you have to rethink your narrative a little bit. Really? It's like, did I miss something here? Is the bond market seeing something that I didn't see? Or are other investors seeing something that I didn't see? And how is that affecting, my thesis of what's to come here for the remainder of this year, and therefore how that impacts my customers, right, from an asset allocation standpoint. So was there anything in that CPI or anything in the market development that explained that 1.5% sell-off between 10 a.m. and 2 p.m.? Well, there was one thing that I can point to. There was a surge in long-term yields. But I got a note here. As for why an interest rate surged, that's something I can't really answer. Yeah. But one thing that we do know is that the U.S. Treasury yield surged 10 basis points. It went up to 4.106%. Again, not sure exactly why that is, but the U.S. 10-year on August the 4th, last week, was at 4.2. So if we were at 4.2 last week and it surged 10 basis points after the CPI print to 4.106, I mean, is that a real line mark in the sand for stocks as to why that sold off? I mean, no, why? Why would that be the case? That doesn't make any sense to me at all. One thing that does make some sense other than the surging yields is that this is just August. And August, from a historical standpoint, we touched on this in our prior podcast last month, which you can check that out at shepherdwm.com. We post all that there. August seasonally is a light month from a volume standpoint.
Right.
Reason for that, mutual fund managers and hedge fund managers, they get vacations too.
Yeah.
So there's a lot less volume, in the month of August. And that's been true historically over and over again. August, from a historical standpoint, is almost a completely flat month to slightly negative month. So generally don't come into August expecting some sort of amazing stock market rally. But I do think the history of August starting out slow is actually a good thing for the back half of this month. So I'm going to touch on that here
right on
as well. So when we get into the CPI for just a second from a historical standpoint, and I'll come back to the month of August from a historical standpoint. So we've seen the CPI obviously got released, and 7 of the last 9 CPI prints is what I want to talk about. So moving into the print, of the last 9 CPI prints, core CPI came below consensus 3 of 9 times. Each of those 3 saw the S&P 500 decline into the week into that CPI release, which is exactly what happened this time. 3 of 3 times the S&P 500 rallied over the next 5 days. So I'm looking forward to a rally beginning next week. And that rally, the other 3 times that this happened, the last 3 CPI prints, it rallied somewhere between 50 points to 240 points on the S&P 500. And I still expect this to occur. Now, again, the key question is whether the current pace of core CPI of below 0.2% month over month is sustainable. And again, in our view, it is. And arguably, the figure that probably most matters in the July CPI is the core services X housing. I mean, we've talked about that for freaking 9 months.
We have, yeah.
That's what the Fed wants to kind of focus on. So core CPI services minus shelter, the figure month over month was 0.22%, which means year over year is just above 4%, 4.03. And Fed Chair Powell has referred to this figure on PCE on many of his calls as the super core services. And actually, there was an article in Yahoo recently after we got that CPI release. San Francisco Fed President Mary Daly stated that we need to see core services get to 2% on a sustainable path. So the Fed will be watching this and core services X housing figure since we know housing is on a glide path forward. So service inflation is still a little sticky. That's what we saw. But the Fed themselves believes that the owner's equivalent rent factor, the shelter factor, is already on a glide down to their target that they're looking for. It's just going to take a lot longer. I actually believe that core services X shelter year over year growth will fall to 3%. We're at 4.03 right now. I think we're going to see that fall by 100 basis points in the next reading. And I'll explain why coming up here right now. The rationale is kind of simple. If you look at the 2 biggest month over month figures that are calculated in CPI, remember it's the last 12 months equally weighted of CPI measures. Well, we're going to be losing August and September from 2022.
Yeah.
August in 2022 is positive 0.52%, way above where we're at today. And then September 2022, it was 0.8%. Again, way above where we're at today. So we're going to be dropping those. So to me, the simple math there is you're probably going to see about 100 basis point drop in that figure. That gets you to 3%. I mean, that's within spitting distance of that 2% target that the Fed's actually looking for. So that's the reason why I think that this is sustainable from a CPI print standpoint. And I expect history to kind of repeat itself going into next week. So we're seeing some consolidation right now. I would argue that's somewhat healthy because it's only about 4.5% of consolidation this week. And we're still maybe like 7-8% away from our all-time high on the S&P 500. So this isn't like, it does make you rethink the narrative when something like that happens, like I said, between 10 a.m. and 2 after a really good CPI print. But when you actually peel it all back and look at it from a bigger lens from a historical standpoint, it starts to make a lot of sense to me from some short-term consolidation, given the market's rallied nearly 20% year to date. So looking forward to next week already.
Yeah, well, that kind of sell-off necessarily wasn't part of it, but I believe, back in June, you were talking about drop in July and seeing some similar effects in the market come in. So you think it's going to continue. That's great.
I do. And if you look at the three things that were driving that 0.22% month over month core services X shelter in July, the first one was motor vehicle insurance. That was positive 0.22%. The next one was recreational services, came in at positive 0.1%. And the third was vehicle repair and maintenance, coming in at a positive 0.05%. Of those 3 things, I don't think anybody's freaking out about, hey, then this is some sticky inflation on these 3 things. It's going to be sustainable.
I can't, the cost of my tire rotation went up 8%. I can't hang. I mean, that is a make or break for some people. I'm not trying to laugh at it, but you're right. As far as like an indicator of, national economic sticky inflation, no, not at all.
100%. And so core services X housing, if we remove all 3 of those things, by the way, For those of you that, would like to know, if you remove those three things, core services X housing would have been down negative 0.13%. And the question is whether one believes the Fed policy is driving vehicle expenses. Not really, right? I mean, this is just a blip on the radar in my view.
Right.
This isn't sticky at all from my perspective. Now, what also happened after we got that CPI print, so this thing's called a Fed funds future odds of September hike and a November hike. Well, before the CPI print that we got, the odds of a September hike were 24%. It went down to 11% right after that CPI print. Again, a big reason why the market popped. Really weird that it reversed all that between 10 and 2 and slightly finished positive on the day, especially after seeing that probability fall as much as it did. Ideally, we want that to be 0. And I think it will be 0 when we get the next CPI print in September, as I just kind of laid it out here. But same thing for November. So before the CPI print, the odds of a November hike were 31%. That fell to 22%. So again, I'd love to see that to be 0 as well. And looking forward to the next CPI print in September to hopefully drive that all the way down to 0. The bottom line is, while equities did sell off, July's CPI report to me is encouraging and it is repeatable. Now, the other takeaway is that equities don't seem to be directly linked to the CPI report itself. So it does raise a couple of questions here. Did the bond market come to a different conclusion? That's the first question I asked when I see all this stuff. We don't think so. But again, if investors were all prepared for lower rates, the pain trade is higher. So it's just from a mental standpoint, right?
Right.
If you're prepared for rates to take a dive and they actually go up, which again, I can't really explain why, maybe other than the simple fact that the U.S. Treasury had issued a whole bunch of, treasuries in the Treasury market at auction. That might make some sense to me, but I don't have a clear expectation of that. But I think mentally on the day, CPI, awesome. Then all of a sudden between 10 and 2, rates are going up on the 10-year and the 30-year. And if investors were expecting rates to be lower, maybe that was a trigger for them to have a sell-off. Other question you would want to ask, are all investors already, quote, all in on stocks? We've talked about this many times already this year. The answer is no. And it would certainly surprise me given that $115 billion were withdrawn from stocks since the start of this year. So again, this is one of the most hated bull market rallies in the history of all time.
Yeah.
So are investors too bullish? Well, we were just speaking with some institutional investors at a conference not that long ago. And so many people were skeptical of valuations of the market. And many think that stocks are, just rising on fumes, just running out of gas. So this hardly seems, if that's the narrative for most people, knowing that $115 billion came out of stocks since the beginning of this year, and knowing that there are still, quote unquote, smart investors, these institutional minds, saying these are skeptical valuations, this would hardly seem to me like we're at a market top.
Yeah. How can you be so bullish with... Sorry. 100%, Joshua.
I'm with you. So our market's nervous about something else is the other question, right? So I'm running out of things to point to logically that would cause a lot of this. Maybe it's the Bank of Japan and the modifications they made to the yield curve. Maybe that could have some sort of lingering effects. China's obviously had an issue as far as, coming out of their, whatever their zero COVID policy was. Everybody thought that as soon as China let everybody, go back to a quote unquote a normal day, their economy would just push the markets higher and be extremely productive and all this stuff. And it just hasn't happened yet. We got the PPI report this morning. That came in a little bit higher than consensus. However, they had to revise the prior month's PPI numbers, and actually PPI came in at 0 the prior month, even though they showed a positive number. So even though the number came in a little hot this morning for the producer's price index, if you put that into last month's revision, going back down to 0, we're actually right in line with what expectations are. So I don't think that had anything to do with the sell-off, if you will. Now, the other thing that I thought was pretty interesting to mention here was the core goods deflating. So a lot of people are wondering, what's going on here? Is this going to be a sustainable deflationary event that we've experienced over the last 2 CPI prints? So I wanted to take a look at the last 15 months of core goods and core services ex shelter month over month. And those things have been falling consistently. We saw that drop by negative 0.33% and falling continuously. And the core services ex shelter is the thing that's been sticky. Like we talked about, owner's equivalent rent, that sort of stuff only gets repriced about once a year.
Yeah.
So that's to be determined on that. But I think even the Fed admits that, again, the owner's equivalent rent part of this, which is a huge part of the calculation, is in fact on a sustainable glide down to the targets that they're looking for. So those were the highlights of all the recent news and data that we've received here. And just want to make sure we're covering everything. Yeah, it pretty much covers everything from the news that we wanted to get to. But we've also are pretty much at the tail end of earnings season. And earnings have been nothing but fantastic. So we only have 33 companies reporting this week. So we're wrapping that up here today. And of the 457 companies that have reported thus far, that's 91% of the S&P 500, 81% of those companies are beating estimates. And those that have beat are beating by a median of 7%.
Ooh.
I mean, these are fantastic numbers.
Yeah, they are.
On the top line, which is revenue, overall results are beating estimates by a median of 3%. So, I mean, across the board here, everybody said this was going to be a recession year. Earnings were going to fall.
Right.
Inflation was going to, probably rear its ugly head again. I mean, we just kind of knocked all those things right down to the bottom. I'm having a very difficult time understanding a bearish person's perspective other than the fact that they probably missed this 20% rally that we've experienced so far. So that might be a good reason, maybe not a good reason, but a reason why they're so negative on a fantastic bull market that we're experiencing right now.
Yeah, it's FOMO to the point to where they want to take their ball and go home and ruin it for everybody else.
That's right. But I mean, this might be the entry point here. So like I said, August and even September can be very volatile, generally not awesome parts of the 12-month period cycle that we're measuring the S&P on year by year. And it's just seasonality, people on vacations, all that sort of stuff. But I'd be a little ticked off too if I was on the wrong side of a 20% bull market and 36% ride on the NASDAQ so far this year. And if you're one of the people that are paying somebody like myself that missed out on all that, you're certainly not a very happy camper right now.
No.
So the question is this sustainable? In our view, absolutely. I just gave some historical relevance as to why we would expect the next 5 trading days going into next week to probably be good. Maybe Monday and Tuesday, depending on the way that Friday today ends. Could be a little choppy, but I do expect a little bit of a rally here between next week and maybe even slightly into September. So we'll be making some decisions here pretty quick as far as, we're going to sell into the rally expecting parts of September to potentially be weak.
Yeah.
And that's the conversation that we're having here at Shepherd Wealth Management, because the one thing that we can control for our customers is our asset allocation. Right. And for those that maybe watching the show for the first time, asset allocation is just a fancy way of saying this is how much of your money is invested in stocks versus bonds and cash. And those are very important things to control, because if you look at something like a modern portfolio theory type of way of building a asset allocation, well, that explains 94% of the variability of the performance over any period of time you want to look at. So you obviously want to have a good understanding of what your asset allocation is and why you're positioning it the way it is. So we've talked about this all year long. The 3 big sectors that we were overweight relative to the S&P was technology, industrials, and energy. Definitely been the right call, where most people consensus said this was again going to be a recession year. And if you're going to go through a recession, the last 2 things that you want to own are technology and industrial kind of companies. I saw it from a different view, looking at what history had to say, and that's why we came to some of these conclusions from an asset allocation standpoint. Therefore, we've had a ton of awesome above market performance. Like, we definitely are beating the market pretty handily for the majority of our customers. Definitely those that are looking for growth. So the question is, I do see more room to run on the S&P. I've kind of put my neck out there and said, hey, I think the S&P is probably going to see a new all-time high. And my price target for year end is 4,900. So you would say, why change anything at all? You've gotten all the growth so far this year that you could get, because you're overweight tech, you're overweight industrials. Energy is finally starting to play ball now, and that's been a nice position to have here in the summer months. What do we do now? We could let it ride, expecting the market to do what I believe it will do before the end of the year here, based on our research, and we would be just fine, just not rebalancing at all. But one prudent thing to do is kind of continue to keep an eye on the future. Well, next year is a presidential election year. I'm going to have a lot to say about that from a historical standpoint as we get closer and closer to 2024.
Yeah.
Knowing what I know from a historical standpoint about election years and having worked with clients through several of them at this point, generally speaking, Q4 of this year should be strong, holiday season. Q1 likely to be pretty okay. And then that 2 quarters leading up to the actual election date in the fall aren't great. So I'm going to go ahead and take this as an opportunity. Potentially, I haven't made the complete decision yet, but I'm leaning towards the idea of taking about 10% of profits off the table for customers, definitely in IRA accounts, because clearly it's not taxable when we take profits inside of an IRA, and leaving that 10% in a money market, getting around 4.5 to 4.9%, depending on the day, and having that ready to go to be deployed should we have another week or two like what we're experiencing right now. I, again, expect next week to be good. I kind of expect the majority of the rest of August to be good leading into September. And I think the market probably won't do a whole lot. If anything, could sell off leading into the CPI print that we're going to get in September. But again, if the CPI print comes in the way that I expect it to, I expect the market to take off on another rally leg up. So I would like to have maybe about 10% of the profits that we've already made for customers sitting there ready to be deployed should we go through another week or two like this in early September leading into that CPI print. So just picking up some additional shares that we already love anyway.
Right.
The companies that we probably already have in the portfolio, picking up some additional shares at a lower price, expecting the back half, the last 3.5 months of the year, to be pretty strong. So that's something that we're anticipating.
Yeah. So we're still thinking 4,900 in the S&P.
4,900. And the funny thing is I don't usually make a lot of those announcements. And I didn't have a price target per se on the S&P 500 coming into this year. I did have a completely different perspective than the general market did. But now that has played itself out in the way that we were expecting it to, that makes me feel pretty comfortable about actually putting a price target out there. Now, the funny thing is, and we did talk about this in prior podcasts and I wrote about it in newsletters, like all the major Wall Street firms, the big banks, the UBSs, the Chases, everyone, they were calling for a median price target in the S&P by year end at 4,000.
Yeah.
And if that's the median, there was a lot of people below that and only just like 4 or 5 firms that were calling for the S&P to be around 4,200. So not a big difference compared to everybody else.
Right.
So I had obviously a different view, didn't really have the, confidence at that time to say, hey, I think the market's going to do 4,800 or 4,900 back in January, because we did come off of a very difficult 2022 year.
Yeah. And every sentiment, every news channel was saying, buckle up, buttercup. This year's going to be more of the same.
And I like that. When everybody's on one side of the boat, you probably are better off starting to think, should I be following the crowd here? Because generally the crowd is wrong. Like the Fed, they thought that interest rates or inflation was transitory. Like everybody said it was transitory. It freaking wasn't.
No.
And then they had to jack up rates more than they ever have in the history of mankind in the shortest period. And now they're quote unquote data dependent. Well, the problem with their data dependency is it's so backward looking, right? Using this CPI measure of 12 months equal weighted, and then you drop a month as you move on. I mean, just by dropping August and September of 22, like I said, it should bring this down quite a bit, just like it did last month.
Yeah.
So I don't know why all the selling is actually occurring, but I'm okay with it. And when we get the rally that I'm kind of hoping for in the next 5 trading days going into next week, might use that as an opportunity to sell into that as the S&P regains its footing, getting back above 4,500 and probably selling in somewhere around the 4,550 to 4,600 leading into the next CPI print. And when that thing comes in below consensus and the Fed confirms that they're not going to be increasing interest rates in September, I think the odds of that November hike are going down substantially. And there's your green flag. I don't know what else bears could point to say that this is not a sustainable bull market.
Yeah, I don't either. I mean,
I'm excited.
I'm just the guy who produces the podcast, but listening to your expertise for months now, and even seeing the turnabout that the Fed's hawkishness has recently taken. I mean, it's so much more measured and more reflective of, like you said, not only backwards looking data, but kind of the reality data that's been coming in. You know, it's that they're seeming to acknowledge these lag effects and like, oh, well, if we keep getting what we have, then, you know, maybe I should just back off my tone a little bit.
Yeah. Yeah.
So I don't know where the bearishness is coming from either, other than just the fact that people are so upset that they got it wrong, and people on YouTube just really want the world to end so they have something to drive their views.
I'm with you.
Because, I mean, we see it on our channel. You know, when things are going really well, we don't get near the views as when things are hitting the fan, which is great, right? Because that means that people are happy and they don't have to doom scroll. And
I'm with you on that. The thing about the market, though, I always come back to this. It's made up of human beings, and human beings are valuable, and we're all... You know, we haven't changed hardly at all in over 2,000 years. Like we're still hardwired with these emotions, fear and greed.
Right.
So when things are good, hey, everything's great. You know, I'm so happy. I don't need to worry about the market. And that was kind of true for 15 years leading up into 2022, right? When rates were zero, money was easy to get. That was a Goldilocks sort of 15-year period of time. And then all of a sudden, those people that were having so much fun making, you know, double-digit returns every year in the market without really having to do anything, well, they woke up sometime in 2022 and said, oh, I forgot I could actually lose money in the market. And then that fear part kicks in. What's important about that is, as we know, as we talk about a lot, you know, behavioral finance has shown and proven that human beings feel losses twice as much emotionally as they feel good about making money.
100%.
And when they see the red arrows on their computer screen, you know, after 15 years of mostly double digits up and to the right, that causes people to panic. And if they're doing this all by themselves without looking at what history has to say, and Buffett famously again would say that human beings, we know for sure, do not learn from history. That's what this show is all about. If you're a do-it-yourselfer, this is the best show that you could possibly watch, because I'm going to tell you what's going on in CNBC. Yeah, that is the headline news. But here's what history has to say about all this stuff. Now you can actually formulate a game plan, because if that happened prior, and we know the market's made up of human beings that are valuable, and we know that they're consistently valuable, then now we can come up with a game plan for how we're going to, you know, manipulate that asset allocation to take advantage of what everybody else said into this year. This was going to be a bad year. Well, if you looked at what history had to say, you can have a completely different perspective. And thankfully for our customers, we have that sort of historical perspective. And truthfully, that's the only way that I can control my temperament.
Yeah.
Right? I mean, what else can I point to? If I have to point to what I see on CNBC every single day, and I'm not knocking CNBC, I like a lot of their programs and a lot of the people that are on there. But their job is to get people to watch the show all day long and not change the channel so they can sell ads.
That's exactly it. They need people to put eyes on the screen.
Right.
And when you're saying, hey, everything's actually pretty cool, you're going to get a lot less attention because people aren't looking for what they should be doing.
Right. And the majority of the time, I don't have any actual scientific or statistical data here, but I bet, you know, this could be done fairly easily if you're just willing to sit here and watch the same news channel all day long for several months in a row to get enough data. I believe that the majority of the people that they have on here are bearish, or bearish sentiment. You know, when they come on here and they have to make a case for why they believe the market's overvalued, or why they think it's coming back down to 4,000, or whatever their case is, they're going to make it. And the majority of the time, the people that are on there are mostly bearish.
Yeah.
And they'll occasionally bring in the bullish person in there to say, okay, this guy said this. What do you think? And how do you defend that? So we're getting less and less of the bearish tone just because we're, you know, 7.5 months into the calendar year here, and we're up 17% on the S&P 500, more than 30% on the NASDAQ. And now you're starting to see this widening out in the market where other sectors are participating. I mentioned energy, financials, biopharm, the subsector of healthcare is doing pretty well right now. So again, I'm having a difficult time making a case for anybody in the bearish camp. And the more and more that you see these bearish people start to want to participate in equities, the less and less I want to actually be participating in equities.
Yeah. I mean, obviously not the experts on CNBC, but I think the reason why, you know, and you touched on this last episode, was how much certain, you know, demographics of investors, specifically those in the millennial age, like how much cash they're sitting on, how much you just mentioned earlier was pulled out of the market. I mean, fear because they got hurt last year. And then I think the continued rhetoric, it really is FOMO, and still some of that fear also. Fear of missing out, also fear oh no.
Well, I mean,
so they're wanting to justify why they're not participating, and they're continuing this rhetoric. And it's,
100%. And now they actually have, so if you look at performance of the market, you got 7 big name stocks that have really significantly outperformed, and they deserve a higher multiple because of the cash flow, right? They don't need to finance their business. That 8% means almost nothing to a company like Apple that has a couple $100 billion sitting on their balance sheet, right? I would look at the rest of the market outside of those 7 names, and you could say that, they're undervalued relative to the market. There's a whole bunch of stocks out there that are now starting to participate in this rally that have a PE ratio, of 8 to 15, maybe as high as 20.
Right.
So there's plenty of places to deploy capital if you missed out on a huge rally of some of these big name companies. But you got NVIDIA's earnings coming out here just in a few days. And if they post a number, so Jensen Huang, their CEO, the reason why the stock popped as violently as it did to the upside, we loved it because we were huge NVIDIA shareholders for customers. And I still have not sold a share yet. So I rode that thing all the way up to 450 or whatever, peaked out at here this year. And now it's trading at about 411 and change, I think. So we're still up quite a bit on the position. But Jensen Huang, the CEO, said, hey, we're going to do an extra $4 billion in sales this quarter. So the market was looking for 7. He was like, hey, I'm about to do 11. So the stock shot up. I don't think that he said 11 just to say 11. I think that he knows that he's probably going to do better than 11.
I was going to say, he's probably setting a threshold he knows he's going to cross, because there's no way you do something like that without understanding what you're saying.
Exactly. So I haven't sold a share.
Yeah.
And I'm very, very excited about the earnings announcement there because if they post something substantial above 11 and they either raise the guidance or affirm it, because they've already affirmed guidance from last quarter that was way the hell above what analysts were expecting to do this year. So if they post a super strong quarter and raise guidance again, that thing is going to have a nice another run, and tech as a whole is going to be pretty dang strong as well. So super excited about future earnings, but that's really about it from an earnings standpoint, about something to get really, really excited about. And the earnings season has been nothing but fantastic. So I don't expect that to slow down either for the rest of the year. So that was kind of everything we wanted to get to. We got any viewer questions or anything else we want to make sure we cover?
We do not. Both the chat and the text line have been quiet today. So for those of you that are actually out there watching on our not normal time, just let you know, I want to remind everybody that Shepherd Wealth Management is an actual practicing firm with clients. So sometimes we do have to on the fly, make readjustments at the time of the podcast, but you can always expect them to come, every 2 weeks approximately-ish. So for those that are watching, I see the viewers there. I really appreciate everybody.
Yeah, this has been awesome. We got a lot of good feedback about the show. We keep adding viewers. Definitely don't forget to hit the notification button if you're going to our YouTube channel. That way when we do post these things, you're notified. And you can check out all of our other material on shepherdwm.com. I'm posting all the monthly newsletters that I send to my clients. I'm letting you guys have a look at that. And I'm going to continue to do that because it seems to help a lot of people. I try to do a blog, a little short, weekly summary of what happened and why and what I'm looking forward to the next week. Try to do that almost every Friday. I post that on Shepherd WM as well. And you can get access to everything that we do right from that website. That website takes you right to our YouTube channel, takes you right to Spotify. It takes you right to all the blogs as well as all the newsletters. So check that out, and you can read up on my background as well as our president of the company, John Ashcroft. He's got a nice picture of his face on that as well. But yeah, we really enjoyed doing this. We appreciate the feedback, and we certainly have a lot more to talk about for the remainder of this year. And then I know for sure next year I won't be talking about interest rates and likely won't be talking about the Fed so much. It's going to be about presidential election stuff and how that actually affects the market. So I'm sure you guys are looking forward to that.
Yeah, if you think the news is skewed now, just wait till next year.
It's going to be the best season of
season 4 about to pop off.
Yeah, it should be good. So I'm looking forward to it. Appreciate all the support, and hope you guys have a great rest of your Friday. Have a great weekend, and I'll catch you in a couple weeks. Take care.